Thank you, Piero, to coming to joining us today. And
thank you
this
for
is your
having me.
Okay, it's your first interview in Taiwan with Monte DJ, right?
Yes.
So we are flattered, and I want to see your perspective, especially in Europe, because you are the fund manager of the Euro Higher Bond, right?
Yes. Yes, I've been managing the fund for 7 years, and Europe, it's an old continent, and Europe has gone through a very deep recession after 2008 and 2009, and we, in particular, internal demand has gone down because unemployment going up. 2014, we start seeing things reversing a little bit in some countries more than in others. So Spain, Germany, and England, UK. 2015, we've seen a continuation of this trend, a positive trend, and we expect this positive trend to continue also in 2016. There are a number of reasons. First one is the oil price, energy prices coming down are a very good news for the European consumer because Europe imports oil. Second reason is ECB purchasing program that is definitely helping sentiment within the Eurozone, and also is helping banks lending more because the problem we have, the banks not lending, and also I would say, obviously the weaker euro has helped the industrial footprint within Europe. So I would say these are the key reasons for a stronger year, stronger 2015 compared to 2014, and given that we expect these trends to remain, so we are reasonably positive. Obviously, Europe will not grow at 6.5% like China. We know that. We are talking always about growth within 1.5 and 2.5 possibly. This year would be on the low end. But coming from a year of deep recession, it's a good step a step in the right direction, I would say.
So is the euro economy is on the right track to recover?
They are improving. They are improving from a very low base. They are improving from a very low base. There are some issues, obviously, political issues. We've seen in Greece. We're seeing now in Portugal. Spain should not be a problem. We have the election in December. There are issues about leverage. Leverage is still high. Unemployment has come down. That's good news. That's but still very high. Still high. Youth unemployment is very high. Some areas in south of Italy, where I come from, south of Spain, we have unemployment, youth unemployment, close to 40–50%. So, it's a positive picture, but within a difficult macro environment.
Okay, but I think the ECB also consider about all like this condition you said. So last meeting, the president of the ECB, Mario Draghi, he said maybe the next meeting on December they will maybe
announce a new
stimulate policies for the economy. And but the problem is, if the ECB they expect to purchase more bonds, but the conditions which is with what they expected to buy is getting fewer and fewer. How are they going to manage that? And what is your opinion or your plan?
I mean, this is a very fair question. I would say the ECB clearly has clearly said that they will announce something in December. The market is already bought into it, so we're already discounting it. It's difficult. It's not my personal job.
Yes.
I'm on the corporate side, but I would say we expect obviously the purchasing program to be extended after September 2016. That was the first date, and also we expect more quasi-sovereign bonds also to be bought. We may have few additional things, few additional maneuvers, decrease in the base rates, but at this stage I would like to limit to this. But obviously with inflation or now not there at all, actually deflation, and there is room to do more, and so I would say the ECB balance sheet can expand. Going back to your question about liquidity, clearly is an issue, and the ECB needs to. I don't think, because it's an issue, I don't think they will be buying smaller corporate bonds issues. I think they will be limiting to the sovereign or quasi-sovereign type of bonds.
So then.
And so I would say, we should expect some, and some news. Obviously, the market is already discounting it, and but clearly the ECB is on a different path compared to the Fed. Fed may announce a Fed hike in December. This is what the market is telling us, and the ECB actually may announce a further purchasing program. So they are a different step in their monetary policy, and that is also the reason why we've seen the weakening of the euro during this year.
Yeah, and I also have a question.
Yes.
According to Merrill Lynch, the European high-yield bond spread has already narrowed to 480 bps, which is lower than the long-term average at 500 bps. So, in your opinion, are European high-yield bonds still a good investment option for investors in terms of capital gain?
I would say, euro yield market is coming from a number of very strong years. So, obviously we cannot expect to repeat the performance we had, for example, in 2012, 2013. I would say that it's true that it's trading inside the historic averages, but it's also true that the quality of the market is higher. We have more double B names, much higher number compared to the historic average, and that tells us that the market is it's a stronger market compared to the past. So while I understand comparing to average historic averages, but we also need to consider that it's a safer market, a stronger market. In addition, default expectations, because of the increased lending out of banks, are going to be reasonably low. Are expected to remain low. So I would say, whether it's I think it's an investment for the medium term. Obviously, the upside is not as high as it used to be. So I think investors need to be warned that they cannot see the historic performances as a lead for future performances. But I would say that taking consideration the good health of the better health of the European economy, then it probably is worth to still have a look at it, and with a at least 6 month view, because it's a very liquid market. It's quite liquid. Bonds don't trade very much, especially now that market makers are not able, because of regulatory reasons, to keep a lot of bonds. So you need to be patient and take the carry. I don't think there's going to be a lot of, in terms of capital gains, probably it's going to be modest.
What about these bonds, the Euro higher bonds, enterprise? What is any positive or negative signal of these companies And do you have like these companies? Do you have any like investment in recommendations?
You know, we invest out of all European denominated securities, corporate securities with a BBB minus and lower. You know, we have a fairly thorough process that we follow, and you know, we have analysts in California, analysts in London, Singapore. So it's a reasonable large team, and we meet management both in New York, both in San Francisco, San Mateo, and London. I meet myself a lot of management teams, and you know, our investment process is quite thorough, and we follow strict guidelines before investing.
What is the guidelines then?
Guidelines in terms of you know, if we believe really the story is suited for our funds, and if we think that the capital structure is the right one, and you know, firstly, when you look at a corporate, you first of all you need to like the business, and second of all you need to think that the capital structure is the right one, because sometimes you may have a good business but too much leverage, and they will default.
And what if this company at the beginning is really good, like a capital structure, but maybe after like 5 years has some problem? How you?
Yeah, I mean, obviously things change. You know, the life of a Euro bond is quite short anyway. They don't tend to stay in the market more than 3, 4, 5 years, although you know the maturity normally is 7 years. But they tend to be called before that. But you know, obviously, you know, things cannot go as you have originally thought. You know, there are a number of things you could do. You know, from the basic one is you know, you eventually try to sell at a loss, because if it has not done well, then obviously you want to sell at a loss. Otherwise, you may try to reach an agreement with the shareholders and eventually restructure the capital structure.
Do you shorten the duration of the bond? So that you don't have to suffer?
Yes, I mean, duration is, I wouldn't say it's an issue for the Euro market. I think the big issues are more in terms of total leverage in the system within the region, lack of we have, you know, a lack of deleveraging during the past few years, particularly government sovereign have increased their leverage compared to the GDP. And financials have started to decrease leveraging. Consumer has increased a little bit its leverage. So I think leverage is still too high in the system, so it has to come down. So that's the key risk. And the other risk is probably political risk, as we mentioned at the beginning. And then obviously it's an old continent, and you know, we suffer some of the issues that Japan has as well. So you know, we need to get out, and that's the reason why ECB and Bank of Japan are big in so expansion. We have to see whether they'll be successful.
Okay, so high yield bond in Europe, the returns is much better than the US ones. Maybe it's due to the region that shows signs of economic recovery recently. But
no, I don't think so. It's more due to, because I mean, US growth is growing even more than European growth. This is the US oil market has been suffering particular exposure to the energy. And metals and mining. And there is a larger components, more than 20%.
But it's better it's good for the Europe, right? because it imports
Yeah.
the oil.
Yeah.
And
What is good for Europe is not very good for US. Yes.
Okay. So how long will this situation last? Like Europe higher bonds?
I think obviously the U.S. oil market it's more attractive from a yield perspective, but has more risk and default expectations are higher in the U.S. It very much depends on the investor what he thinks about the outlook in terms of oil price. I mean, if you think oil prices will go up from here quite sharply, then probably US yield is a better place. If you think that the energy prices, metal minings will stay where they are or lower for longer, this is what they're telling us, then I think euro yield is equally good. I mean, as a firm, we have a positive view also on US yield. Obviously, this year has not done well. Euro yield has done much better. But at least you are compensated for it because the yield in US it's quite attractive. It's much higher than in Europe, above 8%, and so I guess some investors would be looking at it now. That has held off as much as we have seen during the past 3 months in August, September, October. And I mean, October has recovered, but it's now coming down again in November.
You just mentioned that the default rate in the US might be higher, but would it be even higher after the Fed raised the interest rate?
No, I don't think so. They're not. I don't think they are related. Obviously, if you think Fed funds to go up, very, very sharply from here, it's not my job. I'm more on the corporate side. Then we might have an impact there. But no, I would say the default situation in the US is very much due to this to leverage and there was a higher triple C issuance in the past few years, not only energy. There's been quite, the language of the bonds, the way the covenants are written were very relaxed. So that won't help recovery rates for bondholders. So I wouldn't be concerned for the Fed for the time being. I would be more concerned about leverage within the US side companies and how they manage the capital structure in a different environment, especially the energy, but also other sectors as well. They've been impacted by, some of them have been impacted by also by the weaker dollar, by the stronger dollar. So I think that the issue for US yield is not interest rates, not at this stage.
Fitch warned in March that the credit market conditions of European high-yield bonds look very much like 2007. So what is your strategy in dealing with systemic risk that is similar to financial crisis?
But I would disagree a little bit with that. I think it's not like 2007. As I said at the beginning, the credit quality of the market has increased. So definitely the quality, the average quality of the market is higher compared to 2007. Obviously, there are some trends like leverage going up, a lot of euphoria, a lot of inflows. That doesn't help. So yeah, we have to be vigilant by no means. So as a matter of fact, that what I was saying before, that investors should not expect the historic performances, particularly the one posted in 2013, 2012. But they should be more realistic and should be thinking whether the coupon is enough for them, and they should take it from there. I think it's, the euro market has developed very much during the past 8 years. It's now a good alternative, valid to the US oil market. Before it was very small, and now it's independent, and so it has its own investor base. So we have to be vigilant, but I don't think we are like in 2007. We have to monitor leverage up, but the quality of the market is a bit higher. Yeah.
Final question. Just comparing to other higher bonds, and what is the difference? Funds, yes. What is different with the?
Yeah, I think as a firm, as I said at the beginning, I think it's we are more of a global firm compared to some of my peers. And then obviously, some of my peers are very good as well. So I'm not saying that they are not. But we have a global approach. We have global presence. We meet corporates all over the world. Not myself, obviously. I am in London, but I do meet in London. Some of my colleagues meet in San Mateo, where we have most of the high yield team is based in San Mateo. It's in California. And then I would say the fund, it's probably the right size at the moment. It's not too big, it's not too small. It's around 930 million. I think it's a good starting point. And we are a little bit less. We have a beta that is a bit lower than the market, than our peers. So our standard deviation is a bit lower than the market. So that probably is something that investors like. And so I would say that our key strength.
What is your any special strategies, investment strategy you want to tell our investors in the end, or any recommendations?
No, I mean I think I prefer not to give provide names. It's not part of our policy. I would say, as I said during this interview, the market has done well. We need to be realistic. But I think it's a safer instrument compared to the past. You mentioned junk bonds before, but it's a very much an expression of the past. It's true. I mean, they used to be called junk bonds, but the meaning is junk. I wouldn't call it junk bonds anymore. They are high yield bonds, euro yield bonds, or USA bonds.
A lot of fallen angels.
Yeah, there are more fallen angels. There are larger corporates. It's more diversified. So I think it's the strategy is to be take long-term views. Try to trade as less as possible because it's expensive. Bid-ask spread are quite wide, so take longer-term views and create a core backbone of the portfolio that generates the coupon, and then a smaller part that potentially can generate the capital gain.
Okay, thank you, Piero. Thank you very much for joining us today. We really appreciate.
Thank you for having me here.
Okay.